Welcome to the third lecture. As always, if you have questions, then feel free to ask me at the end of the presentation. Before I get started, in case you missed my weekly review this week, just a quick update about my 2024 mentorship. I've created an application form for those who would be interested in joining my private group when this 2024 mentorship is ongoing. When the mentorship begins, all lectures leading up to the intermediate level will be free, and advanced content will only be for the group I am working with. This group will be the only way to get in contact with me unless you are in Casper's mentorship, then you already have access to me. If you decide to join, some benefits would be being held accountable, homework and tests, live calls, live help, and more. The cost of the private program hasn't been determined yet, but as of right now, I'm thinking $50 to $150 per month. In essence, you can think of the program I am creating as traditional school, but for intraday trading. If you are interested, then the application form is in the description below. So now continuing with the lecture. For the two previous lectures, we now understand how to find our higher time frame bias, and we also have a unicorn model to supplement our entries. The concept being taught in this lecture is going to help you navigate the markets and cut down noise, in turn reducing the amount of losses in your trades. Continuing the current syllabus that I have in mind, we will be covering timeframe alignment. Let me know if you have any specific topics you'd like me to cover, and I will add it to my list. Once again, each lecture that I present ties into the trading model that I found consistency with. I would not teach it if I did not use it. In today's lecture, I wanted to cover timeframe alignment. This is something that will help a lot of you guys that get analysis paralysis, and this concept will also help you avoid losses in the market. Have you ever had the market stop you out and then go in your direction right after? This lecture is for you. As introduced in last week's lecture, here are the timeframe alignments. This week, I also include the execution timeframe, and don't worry, there will be examples for each time frame in this lecture. Now that we understand what we're looking for in the market and have an execution model, we can put it all together. In trading, the higher card rules, meaning that the higher time frame always has more significance, which is why it is crucial to be aware of the higher time frame bias. In the context of today's lecture, we look at our higher time frame for internal range liquidity and external range liquidity, our intermediate term time frame for structure, and our lower time frame for executions. When we're looking at the monthly internal range liquidity and external range liquidity, we turn to the daily chart for structure and execute our entry model on the hourly chart. This time frame alignment is generally for position traders. When we are looking at weekly internal range liquidity and external range liquidity, we turn to the 4-hour chart for structure and execute our entry model on the 15-minute chart. This time frame alignment is generally for swing traders. When we are looking at daily internal range liquidity and external range liquidity, we turn to the hourly chart for structure and execute our entry model on the 5-minute chart. This time frame alignment is generally for day traders. When we are looking at 4-hour internal range liquidity and external range liquidity, we turn to the 15-minute chart for structure and execute our entry model on the 1-minute chart. This time frame alignment is generally for intraday traders. When we're looking at the 1-hour internal range liquidity and external range liquidity, we turn to the 5-minute for structure and execute our entry model on the 15-second chart. This time frame alignment is generally for scalpers. Although I do not recommend trading this time frame alignment if you aren't as experienced, as the lower time frame you use, the more your emotions will be affected. On top of this, it's easier to get lost on lower time frames and lose awareness of the higher time frames. Personally, the time frame alignment that I found consistency with is the daily to hourly to 5-minute. As time is fractal, that would mean time frame alignment is also fractal. So how I like to think of it is the time frames are approximately 10 to 20 multiples apart. So for example, if our lower time frame is 1 minute, then our higher time frame would be the 15 minute because it is 15 times the amount of time of the 1 minute. Once again, this is just a general rule of thumb I use. Personally, the time frame alignment I used to become consistently is monthly into daily into hourly and then into 5 minutes. So I actually use 4 time frames altogether. You will find that when all the time frames align, your executions will have a high chance of going in your favor. This is how I achieved approximately 85 to 90% win rate in Q4 of 2023. I also manage my trades very closely and exit as soon as something I don't like appears, so take that with a grain of salt. For textbook knowledge side of things, this is what we are looking for in terms of the higher time frame to intermediate term time frame to lower time frame for internal range to external range liquidity. On the higher time frame, we are waiting for a higher time frame internal range liquidity to be tapped into. And once we tap into the higher time frame internal range liquidity, we drop down to our intermediate term time frame for structure. In this case, we get a market structure shift and then a revisitation to an intermediate time frame PD array. Once the intermediate time frame area of interest is tapped into, we look at our lower time frame for possible setups. In this case, I annotated the unicorn model as this is the only entry model I have taught so far. So once again, on the higher time frame, we're looking at this internal to external range liquidity. Once we tap into this internal range liquidity, we're looking for this external range liquidity. So then we'll drop down to our intermediate term time frame and look for that structure to prove we are moving bullish in this scenario. So we have a market structure right here, market structure shift right here. And then we look at this intermediate time frame PD array that we trade back into. And once we trade back into this intermediate term PD array, we'll drop down to our execution time frame and look for our entry model. So in this case, I annotated that lower time frame unicorn model as that's the only entry model that I've taught so far. Vice versa, the concept stays the same for a bearish scenario. On the higher time frame, we are waiting for a higher time frame internal range liquidity to be tapped into. And once we tap into the higher time frame internal range liquidity, we drop down to our intermediate term time frame for structure. In this case, we get a market structure shift and a revisitation to an intermediate time frame PD array. And once the intermediate time frame area of interest is tapped into, we look at our lower time frame for a possible setup. So same thing is just flipped around. When looking at external to internal range liquidity, the concept also still stays the same. On the higher time frame, we are waiting for a higher time frame external range liquidity to be purged. And once we purge the higher time frame external range liquidity, we drop down to our intermediate term time frame for structure. And in this case, we get a market structure shift and a revisitation to an intermediate term time frame PD array. Once the intermediate term time frame area of interest is tapped into, we look at our lower time frame for possible setups. And once again, in this case, I annotated the unicorn model. So here, same concept, higher time frame, we're looking for that external range liquidity to be purged first. We purge that, and then we're looking for that internal range liquidity. Once we take that external range liquidity, we can drop down to the intermediate term time frame and look for that structure. Once we get that market structure shift, we look for that intermediate term time frame PD array. And once we trade into that, we drop down to our lower time frame, and then we look for our entry model. In this case, I annotated that unicorn model once again. And then once again, vice versa, the concept stays the same for a bearish scenario. On the higher time frame, we are waiting for a higher time frame external range liquidity to be purged. Once we purge the higher time frame external range liquidity, we drop down to our intermediate time frame for structure. And in this case, we get a market structure shift and a revisitation to a intermediate time frame PD array. And once the intermediate time frame area of interest is tapped into, we look at our lower time frame for possible setups. Now I will give some examples of each time frame alignment on different markets so that I can give a more diverse range of examples. I will exclude the scalper time frame alignment because I do not want to influence you guys to trade the 15-second chart. In this segment, I will cover the higher time frame is trading from internal to external range liquidity. In today's lecture, I will not cover external to internal range liquidity as it is easier to mess up in my opinion. How I like to trade external to internal is by using projections to identify when the market is likely to retrace or reverse for internal range liquidity once traded past an external range liquidity. In a future lecture, I will cover external to internal range liquidity once I teach how I use projections. This lecture is also already 30 slides long, so I want to make sure you guys are able to retain the information I'm teaching. So this lecture is essentially a two-parter. In this time frame alignment, it is monthly to daily to hourly on BTC USDT. We look for monthly internal range to external range liquidity, daily structure, and use the hourly as our execution time frame. In this chart, we can see that internal range liquidity has been tapped into, and so we look for daily structure to provide bullish evidence to run higher. Dropping down to the daily chart, we're now looking for structure to provide a reason to go bullish from this internal range liquidity. So once again, I'm going to ask you guys this question, give you guys 5 seconds to pause the video or answer. So where do you see a market structure shift with displacement? And where would you want to see price retrace to before dropping down to the lower time frame for an execution? So here is the answer annotated. We get a market structure shift with displacement once the high from the sell side of the curve was displaced through. This gives us the idea that price is going to reach higher now. We can now look for our areas of interest for price to retrace back into, and in this case, we have a redelivered, rebalanced PD array. So let's drop down to the hourly chart to find an entry. But before I do, so this is the market structure shift right here with displacement. This is clear displacement where we have this high, we just traded through it with a lot of force. And then when we have this displacement, we get an RDRB, then we expect all these gaps below to be breakaway gaps. So that means they should be left open. So once we get this RDRB, we would drop down to the hourly chart to find an entry. On the hourly chart, we see that price has supported higher from the daily RDRB, and so we can execute a trade on the hourly in alignment of the higher time frames. In this slide, utilizing that unicorn model entry, this would be a 2R trade. I hope this example makes it clearer on how all of this comes together. We are still executing our lower time frames, but because we have the higher time frames in alignment, we can confidently take our trades in direction of the higher time frames. You can also see how time frame alignment will help you mitigate the noise of the market, and you only look for high probability setups. So in this case, we have this unicorn model on the hourly chart. Once we supported higher from this RDRB on the daily chart. So we have a low, a high, lower low, higher high, this breaker, and this fair value gap. So that would be the unicorn model entry. Stop loss below this high probability order block, and we trade higher. Following the textbook knowledge, a position trader would target the monthly external range liquidity. This 20R trade took 2.5 months to play out. I'm not saying to do this, but we can see how by being in alignment of our higher time frames, we're able to swing for the fences. This is exactly what I love doing when the market permits. Although I do not hold for monthly targets, I will only hold for hourly targets with a 1-minute entry or even sometimes a 15-second entry. Moving forward, this will be the time frame alignment of weekly to 4-hour to 15-minute on NASDAQ. We look for weekly internal range liquidity to external range liquidity, 4-hour structure, and use the 15-minute as our execution time frame. In this chart, we can see that internal range liquidity has been tapped into, and so we look for a 4-hour structure to provide bullish evidence to run higher. So here we have that internal range liquidity we traded back into, and now we look for that external range liquidity. Dropping down to the 4-hour chart, we're now looking for structure to provide a reason to go bullish from this internal range liquidity. Where do you see a market structure shift with displacement? And where would you want to see price retrace to before dropping down to the lower time frame for a trade execution? Here is the answer annotated. We get a market structure shift with displacement twice through a high from the sell side of the curve that sparks our trade idea. I wanted to include this as this shows you guys that nothing is 100% and that anything can go wrong, which is why we look for confluences of other analysis. Although we may take one loss on this idea, the reward of the trade idea greatly outweighs the loss. We can now look for our areas of interest for price to retrace back into, and in this case, we had 2 unicorn models formed during each of the displacements. So right here, we have this first market structure shift from the first tap into this higher time frame internal range liquidity, which would be that weekly fair value gap. Once we tapped into it, we displaced higher, and then this is a market structure shift right here with displacement, and this would be that unicorn model in the 4-hour where we have a breaker, fair value gap. So from here, you see that you have a reaction, and if you were an intraday trader, for example, then you would have been able to capitalize on that. But if we were using this in terms of a swing trader, then we would have taken one loss. And then once we tap into this one more time, we get another market structure shift right here that sparks another trade idea. And then we create another unicorn model on the 4-hour. On top of that, we get a turtle soup, which is when we take a low or a high within a fair value gap. And so we get this turtle soup, and this would be our trade idea as well. So let's drop down to the 15-minute chart to find an entry. On the 15-minute chart, we see that price supported higher from the 4-hour unicorn. And so we can execute a trade on the 15-minute in alignment of the higher time frames. From the first area of interest, we would execute on the 15-minute unicorn model. And in this case, we take the loss of 1R. So right here, this is the first 4-hour unicorn that we spotted after that market structure shift. And from here, we look at that 15-minute unicorn, and we take the execution and we take a 1R loss. Once again, on the 15-minute chart, we see that price has supported higher from the second 4-hour unicorn. And so we can execute a trade on the 15-minute in alignment of the higher time frames. From the second area of interest, we would execute on the 15-minute unicorn and this time profit 2R. So here we have that unicorn model where we have a low, a high, a lower low, and then a higher high. So then this high is up close candle that price displaced through would be that breaker block. And then we have this fair value gap, and that would create our unicorn model, and then stop loss below this high probability order block. In this case, it would have been a 2R trade. Following the textbook knowledge once again, a swing trader would target the weekly external range liquidity. And so this 17R trade took 15 days to play out. So in reality, this would have been more of a 16R trade as we took a 1R loss right here. And this trade up to here was a 17R win. Moving forward, this will be the time frame alignment of daily to 1 hour to 5 minute on crude oil. This is the time frame alignment I personally use the most, and this is the time frame alignment that I found consistency with. So we look for daily internal range liquidity to external range liquidity, 1 hour structure, and use the 5 minute as our execution time frame. In this chart, we can see that internal range liquidity has been tapped into. And so we look for our 1 hour structure to provide bearish evidence to drop lower. So here we have our internal range liquidity on the daily, and then we're targeting this external range liquidity on the daily, which would be this dealing range low. Dropping down to the 1 hour chart, we are now looking for structure to provide a reason to go bearish from this internal range liquidity. So once again, where do you see a market structure shift with displacement? And where would you want to see price retrace to before dropping down to the lower time frame for an execution? Here is the answer annotated. We get a market structure shift with displacement through a low from the buy side of the curve that sparks our trade idea. We can now look for our areas of interest for price to retrace back into. And in this case, it would either be the fair value gap, or if you want to be safer and wait for more displacement on the hourly chart, then the buy side liquidity raid. So here we have this market structure shift. I wouldn't count this first one as displacement as we just wicked below. The second one, we also just wicked below, so I wouldn't count that until we get this right here, where we trade it into this fair value gap, displace lower, right? And we create a new fair value gap. So that would be the fair value gap I'm interested in looking at. If you wanted to confirm this even further, then you could have waited until we traded lower. And from here, there's a buy side liquidity raid. And in the sell side of the curve, we like to sell above highs, right? So in this case, you would sell above this buy side liquidity raid, and you can look for opportunities here. So let's drop down to the 5-minute chart to find an entry. On the 5-minute chart, we see that price has rejected lower from the hourly gap. And so we can execute a trade on the 5-minute in alignment of the higher time frames. In this slide, utilizing that unicorn model entry, this would be a 2R trade. So here, once again, we have a high, a low, higher high, and then we displace lower, right, to create that lower low. So this down close candle is that breaker block drawn out. We have this volume imbalance overlapping with it. We also have this fair value gap. So then you could have entered either at this fair value gap or this volume imbalance. But for the mechanical entry model, it would be this volume imbalance. And then once you enter, your stop loss is above this high probability order block. If you wanted to be safer and confirm the displacement on the hourly first, then on the 5-minute chart, we see that price has rejected lower from a buy side liquidity raid. And so we can execute a trade on the 5-minute in alignment of the higher time frames by utilizing this liquidity raid. In this slide, once again, utilizing that unicorn model entry, this would have been a 2R trade. So here, once again, we have a high, a low, higher high, and then displace lower to create that lower low. So then this down close candle would be that breaker block with a fair value gap. So that would be our lower time frame unicorn entry. So from here, you enter here, and then you place your stop loss above this high probability order block, as this is the order block that has fair value gaps nested within it, and also is pretty much responsible for this manipulation right here, which makes it high probability. Following the textbook knowledge, a day trader would have targeted the daily external range liquidity, and this 3.78R trade took 19 hours to play out. Moving forward, this will be the time frame alignment of daily to hourly to 5-minute. I decided to do this time frame alignment again because as I was editing, I realized that there was no Forex examples, so I wanted to get some Forex in here as well. So here is an example of EUR/USD. We look for daily internal range liquidity to external range liquidity, 1 hour structure, and use the 5-minute as our execution time frame. In this chart, we can see that internal range liquidity has been tapped into, and so we look for 1 hour structure to provide bearish evidence to drop lower. Dropping down to the 1 hour chart, we are now looking for structure to provide a reason to go bearish from this internal range liquidity. So once again, Where do you see a market structure shift with displacement? And where would you want to see price retrace to before dropping to the lower time frame for a trade execution? Here is the answer annotated. We get a market structure shift with displacement through a low from the buy side of the curve that sparks our trade idea. We can now look for our areas of interest for price to retrace back into, and in this case, it would be the first hourly fair value gap annotated. I also annotated a second area of interest in case you missed the first entry, which would be the second hourly fair value gap. Intuitively, my brain outlines the RDRB resting above it, so I annotated that for you guys as well. You may have noticed, if you look left, the second fair value gap is also an hourly unicorn model. So from the second fair value gap, if you look left, you have this down close candle, right? In alignment of this fair value gap. And that would be that unicorn model because you have a breaker and you have a fair value gap. As one last freebie that my brain intuitively sees is the turtle soup in the final distribution of a market maker sell model. This would be that silver bullet setup that a lot of ICT traders love. So right here, we have a liquidity raid within a fair value gap and we trade lower. So that would be that turtle soup. So let's drop down to the 5-minute chart to find an entry from the first area of interest, as that setup is the focus of this lecture. On the 5-minute chart, we see that price has rejected lower from the hourly gap. And so we can execute a trade on the 5-minute in alignment of the higher time frames. In this slide, using that unicorn model entry, there would be 2 entries. So if you wanted to be more conservative, then you could have waited for that displacement away from the hourly gap and then execute on the second annotated unicorn that formed. So your first entry would have been over here. And then once we displaced away, if this felt safer to you when you were trading this live, for example, then you could have used this unicorn instead, where of a displacement through a low. And then we have that last down close candle that we displaced through. And then that would be that unicorn model. Following the textbook knowledge, a day trader would target the daily external range liquidity. This 24-hour trade from the first entry took 10 days to play out. Although I would say that this trade is more of a swing play or a swing trade. And for this 13-hour trade from the second entry, it took approximately 9 days to play out. And although once again, I would say this is more of a swing trade than in day trade. Once again, I do not recommend doing this unless you have the most insane mental fortitude. And I'm just annotating this to exaggerate why trading in alignment of the higher time frames is so important. So I just want you guys to like quickly visualize yourself in this trade. Let's say you're a newer trader and you're up 7R on your trade. Would you not be very anxious in the middle here? Like we get a retracement and possibly you close out early here, for example. So just try to make it as realistic for yourself as possible when you do your back testing, as a trade like this is most likely not that reasonable unless you are a swing trader. We can see from all the examples so far how a low-hanging fruit is still very rewarding. 2R is plenty per trade. Think in terms of percentages. If you make 2% on an account, and let's say you only find 1 trade per month, okay? So 2% being the low-hanging fruit, and you make 2% on an account per month, would you still complain? So I just wanted to put that into perspective and really point out that this is all you need. Moving forward, this will be the time frame alignment of 4-hour to 15-minute to 1 minute on NQ. I decided to do NQ again because this is a trade I executed live and is a perfect example of time frame alignment. Although I took profit lower than the external range liquidity, I will cover on a future date how I determine targets past external range liquidity. So here we can see we took that external range liquidity, but some may ask, like, how do you know where it's going to go to and when it's going to be reversing or retracing? Most likely, right? So I'll cover that in a future lecture. For now, I want to keep it simple, and you can see by now how rewarding it is when you are in alignment with your higher time frames. We look for our 4-hour internal range liquidity to external range liquidity, 15-minute structure, and use the 1-minute time frame as our execution time frame. In this chart, we can see that internal range liquidity has been tapped into, and so we look for 15-minute structure to provide bearish evidence to drop lower. So we have this internal range liquidity, external range liquidity. Once we tap into that, we look at our 15-minute structure. Dropping down to the 15-minute chart, we are now looking for structure to provide a reason to go bearish from this internal range liquidity. So once again, where do you see a market structure shift with displacement? And where would you want to see price retrace to before dropping down to the lower time frame for a trade execution? Here is the answer annotated. We get a market structure shift with displacement through a low from the buy side of the curve that sparks our trade idea. We can now look for our areas of interest for price to retrace back into, and in this case, it would be the 15-minute unicorn model that formed. So let's drop down to the 1-minute chart to find an entry. For this trade specifically, I executed on the 15-minute unicorn as it was also a turtle soup on the 1 minute as an entry. And once again, that turtle soup is just a liquidity raid within a fair value gap. Following the textbook knowledge, an intraday trader would target the 4-hour external range liquidity, and this 4.58R trade took 6 minutes to play out, so this was a very quick trade. The stop loss is placed at the high of the 15-minute fair value gap. Brings me to the conclusion of this lecture covering time frame alignment and how to use it to trade from internal to external range liquidity. I hope you all found this insightful, and if you have any questions, feel free to ask me. As always, have a great day.